Hello, and thanks for joining us today on the webinar. I'm going to jump right in here. Right now, during this webinar, you're going to learn how you can use the same secrets, techniques, and strategies used by the major Wall Street firms adapted to your personal portfolio, and the exact method that we use to help replace your paycheck. You worked hard to save your money. Now learn how to keep it and have your money work for you for the rest of your life. If you've heard the phrase, time is money, that statement is absolutely true, and it's why many people need to act right now. There's only one variable that you can control, and I'll give you a hint. It isn't time. Complacency is one of the biggest destroyers of futures, and yet it's the easiest to control. Here's some of what you'll discover today. The secrets of how risk management has changed, a low interest rate world, and how to plot a personal roadmap to your financial future. Those are the things you're going to learn today. The definition of your best life might be providing comfortable income in retirement, simply having your money work for you instead of you working for your money, or maybe to provide cash to meet specific needs. And that could be anything. It could be for retirement, maybe a child's college education, that dream car, that dream boat, or that dream vacation. I found that everybody's just a little bit different and nothing is a wrong answer. You're going to learn insider secrets that Wall Street doesn't want you to know. And you're going to learn the big mistakes that virtually everyone makes without actually knowing it. You're going to learn how to consistently follow a simple time-tested process and how that can move you into financial freedom. And you're going to learn the secrets my clients use to get what really matters most to them without giving up their most precious resource. Now, who is this not for? It's not going to be for people who are absolutely certain they can figure out the markets and investing for themselves. You should absolutely do that. It's fairly simple to quick open up an account these days and do it yourself. And this webinar is probably not going to be for you. It's for people with less than $250,000 in investable assets. Well, we can do our best to try and help you, but generally speaking, you need to build up a bit of a base before we can really do our best work. And for people who believe that a computer can understand their personal situation, their dreams, their hopes, their fears better than a human, this is definitely not the webinar for you. You should go find something else better to do with your time. Now, who this is for? This is for people concerned about the consequences of making a misstep in an ever-changing economic environment. It's for people who know they need more than just the latest hot stock touted on TV or the internet to secure their financial goals. It's for people trying to figure out how to pay for the things they truly value. And again, it could be anything. Maybe it's a comfortable retirement and a replacement paycheck. Maybe it's the freedom to do what they want when they want. Maybe it's college and healthcare costs rising faster than inflation that has you concerned. Maybe it's people that want that dream vacation or that home, or people uncomfortable having a robot decide their future, or it's also for people who are currently only invested in index funds and mutual funds. Here's my promise to you. If you'll listen to the end, I'm going to provide you with a step-by-step guide, free of charge, that will chart a course to secure your financial goals. And I'll show you the exact steps to our income-generating system that we call the paycheck replacement strategy. Let me ask you if this sounds familiar. We've got statements from different accounts with differing information about investments that have unknown tax or legal consequences. You see the money's increasing, or maybe it's not right now, but how am I going to come up with the difference between my current paycheck and benefits and what I'll be bringing in once that paycheck stops? After formal work, what does that look like? What do I want for my future, and how much is that going to cost? Does this Sound like you ask yourself these questions? Do I want to travel and see the world? Do I want to see more of the kids or maybe more of the grandkids, depending on what stage of life you're in? Well, why do I want that? And when do I want that? When can I have that? What we found is that some people with literally millions of dollars find out that they can't afford the lifestyle that they thought they could, while others found that they can still live their dream life on much less than they thought. I call this the Snowflake Theory. Everybody's different. I even wrote a book about this. There's no one size fits all investing. And that's where I think we run into trouble with some advisors today. They put a number on you. They try and put you in a box, but everyone is different and you need your own personalized roadmap to financial success in your future. Do you keep thinking that you need to understand all of this stuff to understand the overall direction and the plan, but just haven't figured out how? But you'll get to it someday, right? You ever have that nagging feeling that putting off planning for your financial future is avoiding an issue that gets closer every day? Do you feel like everyone is telling you something different and no one is actually listening to what you want or need? Or is there just too much information and it's just overwhelming? These are just symptoms of the real problem. I'll tell you that you don't need the next hot stock or another top 10 stocks for next year. And how much fixed income versus equity do I need? What's my real risk? You need a single place with the right experience and the resources that has actually listened to you and your personal situation. You need a place that has consistently managed assets for large Wall Street firms over decades. One that can provide you with the secrets and strategies and tactics that those firms use to manage their own resources. What you need is consistent execution of a clear, understandable plan tailored specifically to you, not another financial product with a bunch of hidden fees, and not another speech about, well, just save more and spend less. Not another hot investment opportunity from your neighbor, your brother-in-law, or the guru on TV. You need a customized blueprint, a professional fiduciary, somebody that acts with your best interest in mind to help you consistently follow that plan to build your life, not just your portfolio. I wrote the book on how to build your life, not just your portfolio, because I believe that it's the most important thing. So many people get caught up in building a specific portfolio or trying to follow some sort of system that they forget about their life that they're living today. You don't need another get-rich-quick scheme, and you certainly don't need a robot managing your financial future. You don't need to know how Warren Buffett did it or some other Wall Street guru, but how you can do it right now. Not a model that works for everybody. We're all different. Not a solution to a problem you don't even have. Once you start consistently following this plan, you can take time to enjoy the things that are important to you. You can go to bed at night feeling like your financial future is secure. You can know where to go to find answers when you need them. Now, don't worry, I'm going to give you the exact methodology that we use for our own portfolios to generate consistent income and growth without keeping us up at night, after I tell you about the most important part of any financial plan. I call it the sustainability system to building your life, not just your portfolio. There are 5 simple steps to get the clarity you need for your unique life situation, so you get your time back and your anxiety levels down. Here's your 5 simple steps. These are ones that, when applied consistently over time, allow you to build your best life rather than just a portfolio. But let me tell you a quick story. I'll tell you, I had no idea how to get where I needed to be financially when I graduated college a few decades ago. I started working with some smart, experienced mentors and coaches at a major Wall Street firm. I didn't start at the top. I actually started all the way down at the bottom. I was in customer service taking angry phone calls from clients of that big firm. Even though after so many years of learning in the books, I thought I should probably have a bigger job. I think a lot of kids coming out of college really believe that today. And I get it. You spend so much time on that formal education that you really think that you have it all down. Here's the deal though. I made mistakes. I failed forward. I made some big mistakes. Today, I continue to learn and grow. But most importantly, along the way, I learned the system for growth and I implement it consistently, both for myself and my clients. Along the way, my wife and I raised 6 children and got them started off, all while building into the lives of others and doing what we love to do. This is how I discovered the sustainability system. I was doing all the right things, everything that they told you to do, working hard, saving a portion of each paycheck, all that's important. I was getting another degree and getting more certifications. What I didn't realize is that while all this formal education I talked about earlier, while it was valuable, it wasn't nearly as valuable as the real world experience that I was gaining from what I was doing and who I was learning from every single day. What I learned was that absolutely nothing beats real world experience and great mentors. To be perfectly frank, I was worried, I was anxious. My wife was pregnant with our 3rd child. Where in the world was I going to get the resources to take care of my family, let alone retire or accomplish any of my long-term goals like traveling and experiencing the things that we enjoy? I was so worried I was not able to really enjoy living my life right now. I tried following that hot stock and that hot sector system, and sometimes it worked, and then other times it failed fairly horribly. I tried the completely logical approach called quantitative investing, and that was all the rage back in 10, 15, even 20 years ago. And frankly, it still is in some circles today, but there's some pitfalls to that I learned from real world experience. It's not that you ignore it, it's just that you have to use it with care. It's just a tool that you can use. It's not the whole package. And of course, I tried following the gurus on TV, and I found that none of this produced the consistent results that I really needed. Most importantly, I learned that while you can learn much from historical events and what worked 10 or 20 years ago, those exact tactics and strategies aren't likely to work the same way in today's marketplace because things simply change. The big advantage that I had was that I worked on Wall Street. I was able to learn from some of the greatest minds in the market. I was able to get real world, real time experience managing literally billions of dollars. I learned the secrets and the strategies used by Wall Street and found that contrary to popular belief, and especially today with the technology at our fingertips, they can be effectively applied to smaller portfolios. Along my journey, I discovered myths that are still common ones today. But first, as promised, why some of the old ways of managing risk and generating income no longer work as well as they have historically. The world has changed, and what got you here will not get you where you want to go. Many believe that you have to take significantly more risk for the income that you need, while others insist that the old idea of a 60-40 fixed income versus equity portfolio is going to perform the same way that it did years ago. Let me make a bold prediction. Things have changed. They've changed in a lot of ways, but they've changed for investors over the past several years, and they're going to continue to change. I mean, what has not changed over the years? Do we still drive the same type of cars? Here's just one example of something that has changed significantly. That traditional fixed income, those bonds and CDs that you're likely familiar with, they're unlikely to perform the same way they did in the past, during market downturns especially. It's certainly not providing the same income that it once did. Today's world demands changes to your strategy in order to control risk while still obtaining the income needed in retirement. Back in the good old days, which is when I started in the business, fixed income could really be counted on to increase in value when equity prices fell, all while providing some consistent income that you could count on. At the risk of getting a little too complicated for this webinar, you have to understand the basics of how fixed income is valued. Fixed income prices move inversely to their interest rates. So as interest rates are going lower, the prices go higher and vice versa. So when interest rates near zero, bond prices are not likely to continue to rise as fast as they once did to offset the losses in the equity market. And of course, at that point, they're not providing any income. This represents a big problem for those counting on a stable income stream to replace their paycheck when they retire. Here are the three biggest myths that lead to common mistakes that nearly everyone makes without even realizing it. First of all, myth number one, if you spend enough time researching, reading, and studying, you'll be a successful investor. Well, here's the problem. The world and the economy is a massively complex adaptive system. There's over 7 billion people making decisions each day that impact the market. Those decisions are often not necessarily logical. They're very emotional, so it's very difficult to predict. Governments around the world are making decisions that impact the market and quite possibly benefit them. Natural disasters unfortunately happen and impact the market. Each of these things interact with one another in unpredictable ways. Here is the first issue with myth number one. We all have one resource we can't make more of. We own it, but we don't know exactly how much of it we have. My question is, why would anyone spend this resource on anything that didn't bring them happiness? Of course, you know what it is. It's your time. There's a great book on this called 20,000 Days, where if you look at the average, that's basically what the average lifespan is. We each have about 20,000 days. Are you going to spend even one of those days doing something that you absolutely hate to do? Or are you going to minimize the time that you spend doing things that you hate to do? If you hate your job every day, that is absolutely miserable. And I feel horrible for you. And I hope that I have the opportunity to work with you and make sure that you get to that goal of retirement as soon as possible. If you love what you do every day, why not continue doing it? See, I have an experienced team that helps me. We have the resources, we've got the systems in place to filter out the noise. And here's the key thing. We love to do it. It's fun for us. Okay, we're a little bit nerdy. Sorry about that, but it's just who we are. The secret that Wall Street wants you to believe is that you can figure all this out on your own. And I'll tell you why. It's just one way that they can trade against you and win. Myth number two, you should avoid talking about money. I'll tell you, one of the top reasons for divorce, according to marriage.com, is actually not lack of money. It's actually the avoidance of talking about money that's the problem. The subject of how money is invested, spent, or given feels uncomfortable, so it doesn't come up until there's, quote, irreconcilable differences. And of course, this is not just with your spouse, it can be with family members as well. You don't have to take my word for it. You can look it up right on marriage.com. The top 3 reasons, 2 of them are money and lack of communication. Now, myth number 3 is just invest in the index. But the problem is that this tends to result in 2 big mistakes that people often make. Number 1 is they overcomplicate the problem or oversimplify the problem. And Wall Street wants you to believe this because, again, it makes it easier for them to win. There's a great article on this. You can see the web address there and look it up for yourself, called Don't Be Addicted, the Oft Overlooked Dangers of Oversimplification. Now, oversimplify the problem and you just buy an index fund. Well, here's some problems with that. First of all, you have no downside protection. And by definition, you'll own a lot of bad stocks and you may miss out on obvious market trends. And again, by definition, you're going to be average. So ask yourself this question. Do you get up in the morning and say, great, I'm going to be average today? It's not something that most of us aspire to. Now, you could also overcomplicate the problem and try and do some of this stuff yourself. You end up with an impossible task with too many moving parts. You end up with a lack of focus and a lot of unnecessary stress, and frankly, likely underperformance. Here's the 5 simple steps to the sustainability program that I promised you. Number 1, mindset matters. Get comfortable with the fact that a good plan starts with an honest appraisal of you, by you, and an independent, experienced third party with your best interest in mind, and we call that in the business a fiduciary. The reason, number 1, you just ask any professional sports player, great musician, you pick whichever thing that you want to there, they're going to tell you. They got to where they are because of consistent coaching, practice, and execution, with coaching being right at the very beginning. Tom Brady has more than one coach. There's more than just Bill Belichick there. He has lots of different coaches, and he's one of the greatest football players to ever play the game. Reason number 2, we're unable to see everything from our own myopic perspective. I can tell you that I don't actually manage my own portfolio. I'm certainly very involved in it because I understand it and it's what I do and what I love. But I have somebody else, I have my partner take a look at it and give me honest feedback because I'm simply too close to it. Number 3, real life gets in the way of consistent execution of a financial plan. Things happen, things come up, and frankly, you're most likely going to do what you want to do, what you love to do. Spend time with your family, do things that you enjoy. And if you're doing that, you're probably not concentrating on your portfolio. Number 2, set specific, measurable, achievable, relevant, time-bound goals. Now, I know a lot of people say this, right? This is not a new thing. The problem is that most people don't do this, and they often fail to execute because they don't follow the full system consistently, because it takes work, it takes time. And again, we're going to tend to do the things that we love to do rather than the things that we really don't. So the question is, why do you set goals in this specific way? Well, first of all, is somewhat obvious. It's hard to hit something when you don't know what you're aiming at. Reason number 2 is setting a goal without considering its relevance and if it's achievable for you is going to end up in disappointment. Reason number 3 is not putting a specific time restriction on your goal makes it very easy to let it continually slide away. Number 3, set up a systematic process to regularly evaluate and adjust those goals. The reason that pilots spend so much time on their checklists, and the reason you want them to, is because if they miss one thing on that checklist and it's wrong, the plane's going to go down, right? That's the same way with your portfolio. You have a checklist, you stick to the plan, have a process that you follow. Life happens, things change. You need to be ready for when they do and know exactly how you're going to pivot before things happen. So before that engine blows out on your plane and you're in the middle of a flight, you know what you're going to do if that happens. And I think most of us want to know that our pilot knows what he's going to do if that happens, right? Same thing with your investment portfolio. Don't put your head in the sand like the ostrich. Others like to set a plan and forget about it because, hey, it's easy, and we all tend to like easy. What happens when you set it and forget it? Things change. The market environment change. Things change in your life. And then you haven't changed your portfolio. Again, the marketplace is a complex, adaptive system. If you don't have a plan to adjust with it, you are destined to fail. Number 4, conduct an honest determination of where you are right now. And this one's easy. What's the first thing you do when you need to figure out where you're going to go when you're at the mall? At least it's what I do. I know I'm a hunter. My wife is more of a shopper. I like to go in, find what I need, and get out. Some of you don't do this, but us folks who are hunters and not shoppers, this is the first thing we do. We go look for a map and it says you are here. Then we can figure out how to get where we want to go. Number 5, and this is the most important step, consistently execute the plan. Seems like pretty obvious, right? But this is where most people fail. The very nature of operating in a complex adaptive market is overwhelming to just about everyone. What tends to happen is that after steps 1 through 4 are done, the consistent execution of those steps never happens. So even if you go through steps 1 through 4, this last most important step might be done on day 1, but is it still being done on day 20, 30, 360? Again, it goes back to a complex adaptive system, which by definition changes with each passing second and is impacted by literally millions of data points. So the easiest thing to do is oversimplify, buy the index. Most people have a day job to generate that income that they're putting away for saving for the future. If you're spending your time managing your assets and being good at your job, something's not likely to be being done well. The problem that most people have is just about everyone wants easy and free. It's easy to believe the herd that tells you to invest in a few index funds and believe that everything will work out. Wall Street wants you to believe in free and easy to keep you complacent and feeling good. Most people, what do they do wrong? Well, they don't write down and follow the plan. They don't remain consistent with their plan. They tend to change the plan each time a different opinion or an event is presented in the news, and they tend to buy into easy and free. Let me tell you a quick story about a guy we call Dan. Now, he's a real person. We actually did talk to him, but his real name isn't actually Dan. Dan had 401k plans from previous jobs that he just left there, and he had other accounts scattered around and a savings account at a local bank. Now, interestingly, the savings account was earning less than 0.25% in interest, which means he was actually losing money after you figure in inflation. What Dan didn't realize is that his accounts overlapped in asset classes and individual securities. He was overexposed to some risks while missing out in other areas. He was also paying a lot more in fees and charges than he realized, and he didn't have any downside protection. We were able to have a great conversation about what was truly important to him so we could help him build his best life while helping him build his portfolio. Now, his accounts are all in one place, consolidated, simplified. He has a plan that's being executed to his specification. He knows he can call our team and we'll get him the answers to his questions whenever he has them. He's spending more time on things he loves, including his family, and no longer gets anxious when the news comes on. So how do you get access to the tactics and strategies used by big Wall Street firms? And how do you have the confidence that you'll have the financial resources to meet your goals in the future? And how can you be confident your financial advisor is not just pushing their own firm's products to get paid more when they sell them to you? Well, you get an independent, third-party fiduciary advisor with the right experience to help you perform an honest assessment of where you are. Have a discussion to determine where you want to be and why. Invest the time and develop a roadmap specific and unique to you. Execute the plan consistently, that most important step, and regularly communicate, revisit, and adapt. And be aware of those Wall Street secrets that I mentioned earlier. There's a lot of costs not to fix this. First of all, there's a huge financial cost. You can use a calculator like this one you see here. This one's found on guardianrockwealth.com, which is my firm. And you can easily see how much it's costing you when you just plug in this calculator of the time. That's why it's important to get started right away. Other things that are costly if you don't fix this issue is, first of all, you're missing out on opportunities to do what you love in retirement, or even now. You have exposure. You may have exposure to unknown risks and costs. That emotional cost is the time spent and, frankly, frustrating things and doing the things you don't enjoy. That relational time cost, missed with family and friends. It's a great article here that I'm showing you, is Why Do We Do Things That We Don't Want to Do by Timothy Carey. This is one you can look up for yourself. You don't have to take my word for it. There's a lifestyle cost. Invest time and energy in what you love to do, and do it with those that you love to do it with. It's as simple as that. There's a health cost. Stress eats away at our health silently. Here's another example in American Psychological Association website. Money and stress weighs on Americans' health. The good news is you don't have to stay where you are. The feeling you're ignoring an issue that will eventually hurt you, wondering what you're missing, stressing when the news stories come across the TV or the internet, losing out on the joy of living life because you're worried about your financial future. You've really got two options. Figure it out yourself, risk not knowing what you don't know, losing out on building a life in order to build your portfolio, or you can get help from somebody, again, who has the right kind of experience, who will get you and keep you consistently on track. Now, if you do choose the first option, as promised, I'll show you right now. This is the method it's one of the methods that we use to manage our own money. We're going to give you the exact paycheck replacement formula for free. Here it is. Step number 1, you take the S&P 500 index. Step number 2, you select the top 30 highest dividend paying stocks. Step number 3, select the top 15 highest dividend paying stocks and underweight. This is where it gets a little counterintuitive. You underweight each of them by 25%. Step number 4 is you take that second 15 highest dividend paying stocks and overweight them by 25%. And step number 5, all of those groups, you screen out any companies that have cut their dividend in the past 10 years, and you underweight them. You don't eliminate them, you underweight them by 25%. Step number 6, take the proceeds of all those that you underweighted by 10% and apply it equally to the companies that did not have any dividend cuts in the past 10 years. Step number 7, apply common sense fundamental analysis to this quantitative process so that you eliminate or underweight businesses that clearly have an issue. Here's some examples. Severe negative news about a company, something has happened, a lawsuit, losing a major customer, recent leadership changes, or it might be a significant positive news story that could be a catalyst that may indicate that they're going to do better in the future. And this is part of the reason that you don't just use that quantitative theory and blindly follow it. Again, if that fundamental analysis indicates a company should be removed from the portfolio completely, you just select the next highest dividend paying stock of the S&P 500. Well, that's how we manage our own core income and growth portfolio. So there you have it. That's the exact methodology you use. I promised it to you. There it is. Listen, I enjoy helping people fix the problems that we talked about, and I want to help you. I'm giving you the opportunity to leverage what I have learned over the course of decades managing money on Wall Street, where at one point I oversaw more than $157 billion in assets. This is how I can help. I've set aside time to speak to you and talk about how to apply this time-tested process directly to your life. And as a bonus, you'll receive a copy of the Amazon best-selling book, Build a Life, Not a Portfolio, a guide to your financial future based on your personal values. Cost-free, no obligation. And as an additional bonus after our call, I'll also grant you access to a short video about how to avoid the myth that quantitative investing always works and how to still use quantitative analytics without getting burned. Now, before I tell you why I'm doing this, here's exactly what would happen during the call. First of all, I'm going to listen to you. It's the most important thing I can do, and I owe that to you. I'll share with you how you personally could use the secrets and strategies of Wall Street in your personal portfolio. We'll seek clarity around what you need to do or stop doing in order to build your best life, not just a portfolio. And I'll go over more common mistakes that people make and how to avoid them. Next, if I believe and you believe that based on what you've told me and my experience that I can significantly add more value, then I will. And here's the big high pressure sales pitch. I'm going to ask you, would you like my help completing and implementing a full-scale financial plan? You get to say yes or no. That's about as high pressure as I get. I'm not really a salesperson. I'm simply an advocate for you. Now, my only caveat is that we're only taking a maximum of 10 additional clients at this point. So if I don't offer you the option to work with us, I'll still give you all the value I can during the call, and you'll still get the free bonuses. So worst case scenario, you get the free book that I believe has some value for just about everyone. You'll have the steps to take to secure your best life. You'll know some of the myths and mistakes to avoid as you move forward, and you'll have access to a bonus video where I outline another important myth about quantitative investing. Oh, we said, why are you doing all this? Well, I could have stayed on Wall Street and do the work than collecting a fairly nice paycheck. And I could have kept training other financial advisors how to do the work with their clients. But I began to realize how much I enjoyed talking with individuals about their personal goals and aspirations. So simply put, I discovered my own personal why that I talked about earlier. I'm doing this, frankly, because I love doing it. If we work together, you'll have full access to our team and our resources specifically applied to your situation. You'll get a comprehensive, detailed financial plan specific to your needs, your hopes, and your dreams. You'll get full service and a single place to come for any financial questions you have. All you have to do is click on the button below and register. So space is limited, so click that button to schedule time today. And again, it's free of charge. I'm looking forward to speaking with you. Nothing in this communication should be construed as personal investment advice, and past performance is no guarantee of future results. Investing is not appropriate for everyone, and there is a risk of loss associated with investing in any market. No representation or implication is being made that using any methodology or system will generate profits or ensure freedom from losses. Please remember that investing does carry risk. Guardian Rock Wealth and its affiliates are fiduciary investment advisors. Please consult with us or another experienced qualified investment advisor before making any investment decisions or trying to implement any of the strategies and tactics that we may have discussed in any of our publications.